Want to make yet another update video. We see today there's a ton of volatility, kind of continuation of everything we've seen. And so I want to go through a few things. We had a 30-year auction today, and it was actually very good. Andy Constant gave it a plus, so about as good as you can get. And yet, if you look at the 30-year, the 30-year is up by 13 basis points. So this is a big move, kind of under normal circumstances. A 13 basis point move is already pretty big. But it happened today on the same day that we had a very strong auction. So that's not generally something you want to see. Another point to note, CPI came in today, and inflation, and it actually came in cool. It came in lower than expected by a good degree. I can't remember the numbers offhand, but it beat pretty cool to the downside. And yet we see long end rates up. Rates should be falling on that news, but they're not. They're actually rising. Rates should be falling on the news of a strong auction, but they're not. They're rising. So, like what else could be going on? Today there was Treasury data came out about the budget. So I'll show that. So the federal budget, the expectation for the budget was 130 billion. And instead, the federal budget actually came in at $160 billion deficit. So fiscal concerns could clearly be some of the reason for this rise in rates, you might say. And I do agree that for the past 4 days, fiscal concerns are definitely part of the reason long end rates have been moving higher. But rates were moving higher even before that fiscal data came out. Is this? Yeah, here we go. So here we see the chart that I've been showing. This is the dollar index over here, the DXY, and then this is the 10-year yield, and this is the 30-year yield. So remember, yield is inverse to bond price. So if you see the yield going up, that's because people are selling bonds or shorting bonds. And what we see is that basically all day, rates have been moving higher. This started at 2 a.m.? Yeah, 2 a.m. So it looked like it found kind of a bottom here. Yeah, around 2 a.m. Pacific time. Rates started to move higher. And these boxes are synchronized. So the start of the box is the same for all. And we saw over here with the dollar, we saw the dollar sell off sharply, very, very sharply. At one point, the dollar was down 2.5% on the day, which is just an incredible. I mean, if you go, this has the daily. This is the daily candle for the dollar. I mean, this thing just looked absolutely horrible. It was. There's no other word for it. The dollar was dumping. And so when we go back to rates, they were also dumping bonds. They were all, whoever is behind this kind of bond move was selling bonds. Certainly the 10-year and the 30-year, the long end of the curve, and therefore rates started to move higher again. And this we don't really have an idea of when this starts to become a problem. All day today, all day the past couple days, there have been much smarter people than me on CNBC or Bloomberg saying that we are somewhat close to that the bond. I haven't heard one person say that kind of the moves we've seen in the long end of the yield curve the past this week are not seriously concerning. So I haven't heard anyone try to downplay it. Everyone is basically admitting it's a significant problem. Now, where is the pain threshold? Where is the level where intervention comes in? No one really knows. I don't know. Anyone would just be guessing. But I don't think it's too much farther from where we are now. This is the 10-year yield on a daily chart, or sorry, weekly chart. Let's go on to the daily. But on this weekly, you can get a sense for how the magnitude of this move, right? This candle shows you, especially all the way up to the top of the wick there. This candle shows you this move is massive, and especially considering, right, that the news is should be driving it in the opposite direction. Makes it kind of even more notable. But we'll look on the daily. My red box is getting in the way. But it's clearly breaking out to the upside. Rates are breaking out to the upside. This candle here was yesterday, and this was when basically Trump was forced to come out and reverse course on the tariffs. And that was at basically 450, 451 on the 10-year, and we're at 441. So we're only 10 basis points away. And considering the fact that in the past 4 days we've risen 53 basis points, this could come, that final 10 basis point move, if 4.5 is indeed the level that starts to get them worried, that could come very quickly given the moves we've seen. I'll show the 30-year. It's a very similar story with the 30-year. So these are just insane moves. I'll go the weekly so you get an idea. This candle, the moves that we've, and the week's not even over yet. It's only the first 4 days. This candle is just massive. And again, it's important to remember, like, the average tariff rate for the US on other countries was about 2.5%. We went up to 30%. And now we've come back to about 15 to 25. I've heard varying estimates. I think it depends on how you calculate it. But remember, we do about a quarter of our trade with China is with China. And we are raising tariffs on China. In fact, today, we raised them from kind of an already insane 125%. We raised them to 140, maybe 145. It's hard to keep track, but we raise them yet again, and we do a quarter of all trade with China. And so like, from going from a 2% effective tariff rate to 30, and then just barely kind of coming back off the ledge to say 15, that is still a huge increase from what it was kind of all of this time, right? All this time that it was up at these ranges, that the 30-year bond was kind of up in the 4.7, 4.8, right? People would just point to that. Oh, we've been here before. Yeah, well, we weren't here after 5, 6, 7 xing our average effective tariff rate. So it's a much different picture that we're experiencing now. It was also before CPI came in cool. It was also before fiscal concerns, right? The deficit was kind of blowing out. It was before a lot of things. And so it makes the move that we're seeing in the rates that much more important in my opinion. And I think oil. Well, let's look at break even. So this is the inflation rate, inflation swap. And we can see here that it's basically back to where it was on Liberation Day. So we had noted yesterday that the market was actually pricing in less inflation, which made the yield move even crazier. Now it's pricing in exactly the same amount of inflation as Liberation Day when the tariffs were announced. So again, context matters. Does it explain a 55 basis point move in the 10-year up? I don't think so, right? Something has got to be driving that rate, and it's clearly not inflation, right? Because if it was inflation, this thing would have been up, 2.5, 2.6, right? Like just ripping higher. The inflation swaps would be indicating inflation is a concern here, and we could deduct that from the yield. But that's not what's going on. So it's not inflation. Sure, it might be part of, it's clearly 2.27 percent of the yield of the 10-year yield. Clearly 2.27 is inflation. But again, context. So paint the full picture, and it starts to be a little bit more concerning. Like when you mix it with the dollar, And I wanted to look at a long-term dollar chart, go through some currencies. This move in the dollar, we'll go the weekly. So this candle's the week. You can see we're approaching critical support. This goes back all the way to 2022. This kind of 100 to 101 kind of range. This is critical support. And this thing does, I mean, if it breaks here, I think that'll be something that will be much harder to ignore. But this chart looks really bad. I mean, this thing is sold off. The dollar has sold off very hard. And remember, these 3 days that we flagged, the first capital rotation alert, we started talking about it on because of those 3 days. And you can see yesterday it kind of had a pop and tried to rally, but today it just I mean, is fully engulfing all of the kind of prior candles. It's fully engulfing. It's going to close near the low. This move today in the dollar was massive. Um, and so it's important to remember with the dollar, like normally the dollar behaves as a safe haven, right? US treasuries behave as a safe haven. So money flows into the dollar, into treasuries, meaning bond value up, yield down. But what we see is the opposite, right? Where people are selling, foreigners, in my opinion, are selling and dumping treasuries, getting dollars because it's a dollar denominated asset. So they receive dollars for those treasuries. And then they go, I don't want the dollars. I want something else. So what are they moving to? This kind of gets into the next segment, I guess you could say I want to cover. So we've talked about the Swiss franc. We've noted that this has been a taking over the role of kind of a safe haven trade for a while. But today we just saw. I'll go to the daily chart. Look at this. 3.9% move in the Swiss franc. This is insane. This is a massive, massive move in the franc. And I've noted before, I'll note again, the Swiss franc is like a very stable currency. And if anything, it actually appreciates versus the dollar, right? Like, look at this. This goes back to 2003. US dollar is the numerator, Swiss franc is the denominator. So when the chart goes down, that is Swiss franc, that is dollar weakness, Swiss franc strength, right? So Swiss franc is one of the few currencies in the world that actually gets stronger versus the dollar. And you can see that the only other time that it was at this level was following 2000, following the 2008 GFC and kind of into the debt crisis, the European pigs sovereign debt crisis. So the Swiss franc, this move is insane. 3.9. I mean, look at this chart. This is crazy. So remember, when the chart's going down like this means that people are bidding this. They are selling dollars to buy the franc. So this gives you an idea kind of how, like, if you're thinking of it in franc terms, in Swiss franc terms, this gives you an idea for the strength. This thing is just ripping. And another currency that is showing similar strength is the yen. So again, this is dollar yen. We'll start normal. So this is dollar yen. So the numerator dollar. Anything going down means dollar weakness, yen strength. And we can see that there's this level here between 144, 145 that appears to be pretty critical. Critical level. And the yen has been strengthening for a while. We called a long on the yen back here at 154. And that if you had taken that trade, that would be doing very well. But we think it still has quite a bit of room to run in strengthening versus the dollar. But I will show you now in yen terms, right? So it's maybe a little easier to understand. This is what it looks like if you're just talking about yen strength, right? So this chart looks incredibly bullish. It came out, tested the all-time high. It's pulled back a little bit, but like this thing looks really strong. And at one point, the yen was up like 2.2% versus the dollar. And remember, historically, this is the kind of thing where the yen has faced unrelenting weakness. They've been in the lost decades, right? yield curve control, right? All the things we know about Japan. And their currency has just been brutalized. So the fact that it is showing such strength is notable, right? And it's also notable to remember their debt to GDP is like 230%. Why is this currency showing strength? We know the Swiss, right? The Swiss have a very good, balanced, conservative fiscal policy. They're very kind of stable and predictable. There's a lot of things about the Swiss franc that kind of make sense to act as a safety trade, a safe haven. The yen is a bit more perplexing. We have our own theories, and we've gone through that on X a couple months ago. Why we would long the yen, but the other asset that has shown incredible strength is gold. That's inverted. Okay, here we go. So gold set a new all-time high today, up 4.49%, 4.5% on the week. On the day, look at this reversal. This was kind of the broad-based deleveraging event, right, where it pulled back. And we had said on this day, on Monday or Sunday, maybe it was Sunday evening, we said it looked good for a long. So yeah, I don't know if anyone took that, but these past 2 days are incredibly strong. It's like two back-to-back 3% moves. So gold, franc, yen. That's what was acting as kind of the safe haven. I will also note the euro. This is euro dollar, so we don't have to kind of do any weird things to get an idea. This is euro, and the euro's been showing a pretty immense strength. I wouldn't want to long the euro, but the market believes that, and this could be a lot of European capital rotating home, would be my guess. Clearly, we know about the kind of increase in fiscal spend in Europe, infrastructure, defense, all that kind of stuff. But just in general, we don't really like Europe, and we personally wouldn't long the euro. But it is worth noting that it has been showing incredible strength. And remember, with the DXY, 40%, 40% of the DXY is the euro. So what else has been going on? Correlations. Correlations moved higher yet again today. It's kind of in this range here, but yesterday's kind of rally, right? We saw a reconcentration into the Mag 7 and the high beta and all, kind of everything that had been working the past couple of years. We saw that, and so implied correlations came way in. Today, they are significantly higher than the low yesterday, which was probably set sometime during that rally. So that's implied correlations move. I don't have an update for today. This will probably come in. I don't think that's live data, but yesterday the move index did come in a bit. It's still, right around 130, right around kind of danger zone. And we pointed out that we've been pointing out the move index, and that the 130 level indicated severe dysfunction. And so yesterday when we saw it hit 171 intraday, we were not surprised that there was kind of an intervention in the form of a reversal on a lot of the tariffs. Spreads. So LQD, HYG, we've talked about this before. This is high grade corporate bonds divided by high yield corporate bonds, which can kind of look messy sometimes, so we'll do this. Spreads had started to blow out. They are coming significantly in. So this is a good sign. That is what you want to see. If spreads had started to continue to blow out, that could indicate severe stress at least in the high yield market. Another spread we should point out is the SOFR Fed funds. And this spread is blowing out. And this is more of like a kind of liquidity issue, a kind of interbank funding issue, interfinancial institutions. This takes the secured overnight financing rate, which is SOFR, is a market-derived rate, and minus the effective federal funds rate. And this would be concerning. If you're Scott Bessent, this particular spread, and there's a number of other ways to measure. Like if you have a Bloomberg, there are much better ways to kind of get a picture for this particular type of stress. I don't. Someone wants to buy me one, that'd be great. So I just have the SOFR Fed funds that updates once a day. But yeah, this is if you're a Bascent, this is one of the spreads you would be watching. Because it indicates, right? We know how levered the financial system is, and this could start to get ugly. We do think that a lot of the move in rates is kind of has to do with the basis trade unwind. We do agree that that's part of it. Given though what we've seen in the dollar, we have to believe that some major player, sovereign most likely, is dumping treasuries and then dumping dollars, because that's just what the markets are saying. We just went over it. We just showed where the money is flowing, where the money is flowing out, and where it is flowing to. We just showed it. So it's irrefutable fact that some foreign holdings of treasuries are getting sold, and then they don't want the dollars. They're selling the dollars and rotating into the Swiss franc, the yen, the euro. So it's not really, in my opinion, up for discussion. It's just what is clearly happening, and equities being down again, right? The hallmarks of capital flight: equities down, bonds down, and the currency down. We saw that again today. Quickly, I'll go over S&P just closed down 4.4%. At one point, it was like within 0.1% of approaching 7% decline on the day, which would have triggered a circuit breaker. So that's probably probably worth noting. It did recover a bit after Trump's comments after the cabinet meeting, but this thing looked weak all morning. I mean, this kind of signaled a capitulation, right? You get that kind of final waterfall looking candle, and that's usually the capitulation. And it just so happened that the cabinet meeting was right after that. But yeah, we don't have a direction really from here. We don't think the charts look great for a long. We don't think they look great for a short. Yeah, we have no direction on it. So okay, last thing I want to cover was a concept more than anything, which is, with all the talk of the tariffs, what are the tariffs designed to do? They're designed to address the trade deficit. So this is the goods and services trade deficit. So that's what tariffs are designed to do. They are designed, and up here, I'll put a line. This is basically that's balanced trade up there. So you can see our deficit is clearly blowing out. February had a bit of a recovery, but not much. I mean, this is still kind of insane levels. The goal of the tariffs is to reduce the trade deficit. So how does the trade deficit work? And I'll link to a video I did that kind of goes into this more thorough, but it is a concept I think we really need to drive home. Which is the trade deficit, any current account deficit, and the trade balance is the main component of the current account. Any current account deficit must be balanced by an equal amount of capital inflows. So just assume this is just the trade balance. This is not the actual current account. But just assume this is the current account, and it's $122 billion a month current account deficit. Okay. That means that $122 billion of capital each month must flow into U.S. assets, U.S. financial assets, and a good amount of that is U.S. Treasuries. If you are going to balance trade, you are going to reduce the structural bid for U.S. Treasuries. Let me say that again. If you reduce the trade deficit or eliminate it completely, you will eliminate $120-something billion a month of kind of price insensitive, persistent bid from the rest of the world. This is really important concept to understand because it's in the broader context of 36 trillion in gross debt, interest expense being more than 20% of tax receipts, true interest expense being over 100% of tax receipts, as Luke Groman defines it, Social Security, Medicare, Medicaid, defense, and interest. That is already over 100% of tax receipts. 7% pro-cyclical GDP deficit, utterly insane. We know the fiscal is in awful shape. We know that for 2025, the deficit is actually more than it was in 2024. So again, you remove this structural bid for US Treasuries, I have not heard anyone make a solid argument for who will step in to buy called $110 billion, $100 billion a month of US Treasuries. That's a lot of money. And especially if US starts to go into recession, right? People start losing jobs. It's not going to be them, right? They just got laid off. It's not going to be private households in America domestically. So who might it be? Well, the banks. And so who steps in? The banks. And there's this quantitative tightening has been reducing what are called bank reserves. And if you're interested in the kind of plumbing, I would recommend like George Gammon or Eurodollar, Jeff Snyder. Those guys are much better than me when it comes to all the plumbing stuff. Maybe I'll do a video, one day, but I would point you in their direction if you're interested in that. But basically the way things work is the Federal Reserve, there's money, called a monetary base, which is real money. Those are called bank reserves, and those are stored at the Federal Reserve in an account, right? If you're Wells Fargo or JP Morgan, you have an account at the Fed. And what's in that account is what's called bank reserves. And what we've seen, part of the idea behind quantitative tightening was to reduce the level of bank reserves. There's too much money in the system, and they need it, right? Too much inflation, too much money flowing around. They needed to reduce that. So getting kind of bank reserves down was one of the methods. I'll try to find that's other than reserve balances. Reserve balances, here we go. So this is the bank reserves. And you can see that from the peak, they have indeed come in, right? From a peak of 4.2 trillion, they are now down at 3.4 trillion. There is a concept called the lowest comfortable level of reserves. And no one knows where it is. Some people say it's a particular portion of GDP, a particular share of GDP. Everyone just kind of guesses where. No one really knows where that level is. There are certain things we could watch. So for Fed fund spread, for one, right? Like there are certain ways to get a handle on it, but in general, no one really knows. But basically, given a reduction in the trade deficit, you're removing, 110, 180, 90, however much they reduce the trade deficit, you will be reducing that amount of demand for treasuries. And the only people that could step in to kind of replace it would be domestic banks or foreigners. We know what's going on with foreigners. Don't think it's going to be them in the midst of a trade war. In fact, they're doing the opposite. They're selling. So again, all of this kind of just to describe a concept, because as we reduce the trade deficit, it is reducing a structural bid under U.S. assets that has been there for many, many years, and we will be removing it. If Trump and the administration is serious about balancing trade, which I tend to believe they are. But essentially, you're very quickly arriving to a point where it's like, okay, well, we know that treasury supply is going up. We know the deficit is actually increasing compared to expectations, compared to last year, same time last year. We know all these things. So supply is actually increasing faster. Bond supply, right? More debt. The debt is increasing faster than we expected. And you're talking about removing price insensitive demand from the foreigners by reducing the trade deficit. Hopefully this paints a picture that bond prices are very likely to fall in this environment, right? Which means yields will rise. How long do yields rise? What level before it gets to a point where it bankrupts America and the Fed has to step in and engage in quantitative easing or yield curve control or whatever sort of program they want to name it, some form of debt monetization. I will point out, Joe had sent me an article, Joe Carlasari. I recommend following him if you don't follow him. Smart guy, but he had sent an article discussing this kind of potential for removal of the SLR exemption. And again, if you're into all the monetary plumbing stuff, like Jeff Snyder, George Gammon, those guys are good. Conks, Conks on Twitter is also super knowledgeable on that. But basically, it's a regulation that by removing the SLR, by exempting the banks from the SLR requirement, would kind of theoretically expand their balance sheet capacity to absorb treasuries. But in general, I think the concept here to remember, the main point of it, as you balance trade, as you improve the trade deficit, you are removing structural price insensitive bid from foreigners for US financial assets. This includes equities. And so when you're starting to consider, what sort of where you want your money, I'm not a financial advisor, but hopefully, this is educational. We know the supply, the new debt that must be issued, we know that is increasing. The supply is increasing faster than we thought, faster than this time last year. We know that the demand, if they reduce the trade deficit, will be falling. That means bonds down, yields up. And eventually there will be a point where that doesn't work. So it's kind of this huge headwind. When we're talking about bonds, we're talking about rates, interest rates, yields. When we're talking about all this stuff, it's this huge headwind that I think not enough people are talking about. And so I did want to mention, hopefully that was helpful. I did do a post talking about, where was it? Talking about my theory for QE. I published this on March 6th, though, like a month ago. And you can go check it out, read through it. No one was really talking about this, so I thought it was just interesting to get a discussion going, if nothing else. But go check that out. That's on my profile. But it does seem like that is the direction things are headed, that the balance sheet will more than likely need to expand at some point in the relatively near future. So hopefully that was helpful. Another crazy day. We'll see what tomorrow brings. I think I covered everything. There's a lot going on. Oh, oil. I didn't touch on oil. So going back to rates, going back to bonds and the yields, and what are they indicating? If they were worried about inflation, you would not see oil selling off so hard. So crude is now, NYMEX is now below 60. We'll go to the daily, not so short-term time frame. You can see that crude has just fallen off a cliff. I think we measured it at like 20% at this low here. Yeah, it was like 19%. Here, kind of, you could call this an inverse head and shoulders. Maybe that it's found a bottom and it goes higher. I don't know. I wouldn't have a trade on this. But you would not see oil falling precipitously off a cliff like this if you were worried about inflation and kind of stimulative economic growth. And that's what we've seen. This is pricing in kind of a global recession. The fact, and we noted it a couple days ago, the fact that it just knifed through all the support that it had, and just knifed through it like butter indicates, this is a strong move, and it's for a reason. The market, indicates that, believes that global growth will be slowing. So, yeah, oil is certainly not indicating inflation concerns. Inflation swaps are certainly not. We think it's a mix of basis trade unwind, broader deleveraging, and foreign selling, because there's got to be some element of foreign selling. Otherwise, the dollar would not be moving down in tandem with the bond selling. So again, hopefully that was helpful. Another crazy day. Hopefully tomorrow's a little bit more calm. But yeah, hopefully that helps.